to loosen controls and kick off this new strategy of selling NVIDIA chips to China?
The main focus, as I understand it, is that H200 is 18 months behind Blackwell, generation to generation, and that's the comfort level this administration has. NVIDIA's down 1.3% in the session right now. The other big report out there is from The Information, which reported that DeepSeek smuggled in thousands of Blackwell chips into China, getting them from countries of origin where they were allowed, dismantling the servers. NVIDIA has come out with a statement, Maggie, pushing back on that report. Let's start with that NVIDIA statement, please.
Yes, so NVIDIA has said that these smuggling claims are a bit far-fetched in its own words, and while it investigates every tip it receives, it hasn't seen evidence of this. Now, one interesting thing from the report, Jensen Huang has said before that these Blackwell racks are just a bit too heavy to be feasible to smuggle, but this report from The Information did say that the smuggling for DeepSeek took place in these sort of 8-chip segments that could potentially fit in a suitcase.
Bloomberg's Maggie Eastland, who's out in D.C., covers the intersection of tech and politics with the reporting. Thank you very much. Another story, Amazon pledged to invest $35 billion in India over the next 5 years, boosting its spending in the key growth market to expand in businesses from quick commerce to cloud computing. The e-commerce giant says it will invest in areas such as AI and logistics infrastructure, and that the planned outlay through 2030 will help create an additional 1 RPO is a term that gets bandied around all the time. But basically, it's a backlog, right, of business. Yeah. 500 billion as it stands. Yeah. As Bloomberg's reported it, quite a lot of that is OpenAI. Now, in the future, if something happens and a deal falls through, often in the contracts, there's some kind of penalty for cancellation or severance. But the question's still out there. How do we know that OpenAI in particular is good for it? That they'll be able to actually front up on the projects that they're committed to?
Yeah, I mean, that's a fair point, as you say. But if you look at right now, there are like a handful of AI companies, like 3 or 4, OpenAI, Anthropic, Meta, and XAI. So Oracle got most of them, except Anthropic. So yes, and OpenAI is the trailblazer in that. So if they have that as a customer, that's, I think, most important at this point. To your point, can OpenAI pay or that contract will fall apart? Look, this is a non-cancelable contract, what Oracle says. So with that, and there will be demand. If we think about AI at this point, the rate it's growing, probably will need that demand at this point. But I think if you look at the concern, Oracle lost more than $300 billion market cap. You know, and OpenAI contract is only $300 billion. I think, if I remember, it's $322 billion dollar market cap loss. So even investors are more skeptical beyond even OpenAI at this point, which we don't think, like, core business is still doing well. The way we are looking at it, you asked about the price target. I think if you're an investor, you need to believe on this long-term AI story. Growth is accelerating, $21 EPS they guided for fiscal 30, and if you discount it back, even applying 25 times, we get to this $400 price target.
Sidi, we just have less than a minute here. Do you like this co-CEO structure and the leadership of Oracle?
Yes, I think the way right now OCI is very important for Oracle, so that's why they're separating OCI. Because Clay is going to he's going to supervise, he's going to look at that business, and rest of the application and rest of the business, Mike Sicilia is going to do it. I think this model works. Larry's still there. He's the chairman. He's leading the group, leading the company there. So we like it. I think we'll see how it goes.
Oracle down 0.3%. We're treading water. That is the big earnings print after the bell. Siti Panagrahi of Mizuho. Great to have you on the show. Thank you. Now, coming up, Netflix is back to borrowing, and it's heavy. But now it has a stronger balance sheet to make the case. We're going to go back to the big Warner Brothers Discovery saga. Coming up next, we're going to get the analyst tape, we're going to get the reporting, and then we're going to go bigger picture on what's happening down in Hollywood. Halftime. This is Bloomberg Tech.
At any point in your tennis career, did you say, I've had enough and I'm just going to retire at the top? Do you ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round of the finals, but you have to show up for press conferences before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for my team, for my sponsors. As I look back, I'm proud of that.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back to Bloomberg Tech. Probably the story of the week, maybe, has been the saga around Warner Brothers Discovery. Two competing bids, one from Netflix, cash and stock at $27.75 a share, which is just for the streaming and studio. Stocks have traded like on the week. We're not quite in the sort of discussion territory around arbitrage. In other words, looking at the gap between where the stock's trading and the price of the deals offered, because it's a live situation with multiple bids. But we are looking at the structure of the deals. Now, Netflix is looking to become Debtflix again. Do you see what we did there? After cutting back on debt during the pandemic, it's back to borrowing heavily to finance its planned acquisition for most of Warner Brothers Discovery, the caveat that they'd spin off the legacy network and cable lines. The difference is that now Netflix has a stronger balance sheet. Hot off the press, just hit the wire, Bloomberg's cross-asset reporter Emily Grafeo has the deep dive. Debt is becoming so important generally across technology. But in this case, with Netflix, it is a change of corporate policy in what is a potentially very big deal. What are you reporting?
It really is, Ed. So what we found is that this term Debtflix was introduced a couple years ago by some detractors when the company was rated high yields. They really built their business around borrowing heavily in the junk bond market. And some people didn't like how much cash the company was burning, but they've really turned that credit profile around now. So now the company's rated investment grade. That allows Netflix to tap into a deeper market, more investors here, and they have to raise a lot of debt to finance this acquisition of Warner Brothers. Bloomberg Intelligence estimates that right now they have about $15 billion of debt. That's going to about $75 billion given the current terms here. But what we're hearing from a lot of different credit analysts is that Netflix has the balance sheet to fund this. So it's a turnaround story here. They are Debtflix. It's a fun term. I wish I could take credit for coming up with it, but I did not. But again here, it's investment grade debt, and it's debt that most analysts are confident Netflix can actually still keep that investment grade rating. And it can actually even potentially raise more debt if need be to top that hostile takeover bid because that balance sheet is so strong, Ed.
Bloomberg's Emily Grafeo. It's a must read on the Bloomberg terminal. Netflix to Debtflix. Check it out. All right, let's bring in Laura Martin for more on this deal. There is a lot more to discuss. Laura is senior entertainment analyst at Needham & Co. It's one of these situations where there's the Wall Street view on this deal, the structure of the deal, and then there's the, what does this mean for Hollywood? And the reason I'm so excited to have you on the program is I think we could probably talk about both. But this is the first opportunity I've had to talk to you about two competing bids. I set the stage for it on Netflix's offer, cash and stock, and Paramount's offer. What is your position at this time, and what is your research into the competing bids?
So, I mean, I think the kudos have to go to Zaslav for creating this auction for an asset that's worth $12. We're now at $30 a share. And now we've heard over the tape this morning that both Paramount and Netflix have said they could go higher. So far we have a 300% premium over what the assets were trading at before the auction rumors. So first of all, kudos to David Zaslav and the Warner Brothers team for selling an asset dear. In terms of who wins, we are much more sanguine about Paramount's, or P-Sky is its ticker, regulatory ability to get it through the Trump administration.
Right.
We think that there are real issues with Netflix being successful, not only with Hollywood talent who see this as anti-competitive. I sit in Hollywood, as anti-competitive, especially because Netflix has said repeatedly it does not believe in the theatrical box office release window. And so all of Hollywood is scared to death that if suddenly Netflix owned Warner Brothers, that within 5 years they would stop releasing films in the theatrical box office, which is why we've seen pressure on the exhibitors also. So I think Hollywood is really negative, or let me say it this way, much more negative about Netflix taking over Warner Brothers than P-Sky. I would say that. And on the money side...
Let me jump in real quick on the money side. We will get to Hollywood, particularly technology, because Netflix's competency is the algorithm to an extent, and the library and the content. But I just want to go back and back to basics and what you said. $12 with Warner Brothers Discovery. You're not the first person to make this point, Laura, but just explain the basics to our audience, please. People do feel that the value of what either entity ends up getting may not be at $27.75 for the studio streaming, or $30 for the whole enchilada, as I keep saying.
Right. So, I'm comparing the trading price for WBD, Warner Brothers, for a year. Essentially, it was falling, and it hit about a $12 price before the first rumor of a P-Sky bid started the stock moving up. And then I can't remember the Larry Ellison first bid or the David Ellison first bid, but now we're up at $30 a share for the whole thing, and that includes $27 from Netflix for studios, plus the idea is there'd be a $2, $3 stub left trading for the networks division, which would add up to $30 also. But in theory, so anyway, I'm saying we're at $30 for the comparable asset that was trading at $12 before the auction began for this asset.
I think there's a lot of value in that answer, because the next question is, of course, about antitrust and what the combined entities would look like in either case. You said you believe, or you're more sanguine about Paramount Skydance combined with Warner Brothers Discovery. Why?
Okay, so in streaming, in the streaming industry, Netflix has over 300 million global subscribers, and HBO Max has 150. So together, there's some duplication there, but let's just call it 450 subscribers, which is 40% of the streaming market. Whereas Paramount, or P-Sky it's now called, has 75 million subscribers that you would add to the HBO, which is 150. So now you're at 225 million subscribers. Much smaller market share of streaming than if you combine Netflix, which is the industry leader, with Warner Brothers HBO Max asset, streaming asset. So I would say that's one reason. And then the Hollywood studios, as you know, Netflix is one of the largest global creators of content, and you would combine it with Warner Brothers, which is one of the largest global creators of content. They have different windows, meaning distribution windows, meaning Netflix primarily creates for television, direct to streaming, the television screen, and Warner Brothers primarily creates content for both TV, but also the film business. It's a big film distributor. So I think the idea is putting these two huge content creators together would dampen competition for talent and lower prices for talent, and also raise prices for consumer. That is not a concern with P-Sky buying Warner Brothers.
Laura, we have less than a minute. Netflix would argue, and I am simplifying, that it would simplify it for the consumer. Having HBO Max, Netflix, people have multiple subscriptions. But it sounds like you don't think that argument will make traction.
Oh, Oh, no, it would simplify it for the consumer, but if they collapse, the thinking is they would collapse Netflix and HBO Max, great. But what happens to the price? The consumer is going to get a much higher price if you add those two things together. So it's simpler, but really monopoly policy isn't based on simplicity versus complexity. It's based on the price to the consumer and consumer welfare. And price is part of consumer welfare. Actually, simplicity is not in the laws as a driving factor, but price is. And price would go up for consumers if they combine those two assets, I think.
Laura Martin of Needham, it's great to have you back on Bloomberg Tech. I suspect we'll be talking about this deal for quite a long time to come. Thank you. Sticking with entertainment M&A, Disney co-chairman Dana Wollman sat down last month with Bloomberg's Emily Chang for an episode of The Circuit to discuss broadly the M&A landscape and what she thinks of the competition coming out of a potential merger. Listen to this.
I don't worry about a stronger competitor coming out of it because we already went through an incredible transformation in 2019 as Disney integrated the entertainment assets of Fox. We already went through, a big M&A event to expand our library, to increase the amount of IP that we ultimately could take over the top directly to the consumer. So I'm not worried right now. I also think whomever ends up in this situation acquiring WBD or any asset that's available, these are situations that require a lot of time. Time for regulatory approval, time for integration, time to figure out, how to combine apps, a lot of the things that we've already been through.
So Disney co-chairman Dana Wollman, along with Bloomberg's Emily Chang, again recorded last month. You can catch the full episode of The Circuit tomorrow at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg Television. All right, coming up, Elon Musk's SpaceX aims to blast into the record books with possibly, maybe, ready for liftoff, the biggest IPO of all time. That conversation next. This is Bloomberg Tech.
Good call outs, healthy systems on the booster as it starts to pitch over the Gulf.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
What is a media executive doing running a toy company?
Well, the opportunity was to take a company that thought it's a toy manufacturing company and turn it into an IP company.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're 12th year in and you're just hanging on
Stay tuned. You won't want to miss it.
In case you missed it on Bloomberg Brief.
This is a big difference from April. Remember when there was no place to hide? And now, even though the 10-year is below 4%, if you start to see the labor market showing signs of firing, whether government or the private sector, I think then the 10-year has a lot of room to decline, because then the Fed's cutting into accommodative territory, not just getting to neutral.
Don't miss Bloomberg Brief, live every weekday.
Okay, back to our top story. SpaceX shooting for the stars yet again, this time in the financial context. Sources tell us the Elon Musk-led space company well underway with plans for an IPO that would seek to raise far above $30 billion, with the targeted valuation around $1.5 trillion. That would make this, by money raised, the biggest IPO ever. A representative for SpaceX didn't respond to my many requests for comment. Joining us to discuss is Will Whitehorn, chairman of Seraphim Space. Will was also former chairman of Virgin Galactic, somebody who's worked side by side with Richard Branson in the domain of commercial space. We have a lot to get to. Seraphim, an investor in all kinds of different space assets. And it's the space asset that I think is central to this SpaceX IPO story. My reporting is that they want to raise the capital for the SpaceX AI cluster, the SpaceX AI stack, space-based data center. Your reaction to that, Will?
Well, I think that's probably right. And I think that this is a seismic event for the entire space industry. We're not going to see the like of this. I think it's going to cause huge changes to the companies that are suppliers to SpaceX, to the whole massive kind of environment that they've created, particularly in the United States and in the UK. Some companies, there's a company in the UK called Filtronic, for example, which has become a major supplier to SpaceX. Many of the companies in the Seraphim portfolio, they launch on SpaceX rockets. Starlink has obviously, when you link Starlink to AI, to data centers, you are seeing an entire ecosystem of businesses growing up. And many other constellations will benefit from this. There'll be in-orbit servicing, more data analytics coming out through the space industry. Space and AI will become interlinked in a way they've never been before. I mean, space really is going through a lot of change as it goes through this industrial revolution.
Will, we're going to question, report on, react to wherever the valuation of this company settles. My reporting, again, is that the target, based on what they want to raise, the percentage of the company they offer, $1.5 trillion. But macro, this is an industry, private commercial space that's growing. What is Seraphim seeing? What are the numbers that you're tracking on how an industry is basically growing out of SpaceX's wake?
Well, I'll give you an example. We've got one of the biggest companies in our portfolio is called ICEYE, which has this very special kind of aperture radar. The demand for it has gone through the roof. ICEYE's business plan has ended up being 2 years ahead of plan. They're in profit already, and they've just in the process of a very big fundraise. Other companies like Hawkeye 360, Satellite View, Allspace, all of these companies in our portfolio are all doing very well and getting ahead of their business plans very rapidly, because the demand for data from space is going through the roof for both climate change, defense, national security, communications. I mean, everything is relying more and more on space. And of course, as people get scared about the underground and undersea cables that supply the internet, the demand for internet data from space is starting to rise as well in the fintech sector. So everything is happening all at once. The insurance companies want space data because they realize it's more accurate than ground-based data for agricultural assets, buildings, infrastructure projects. So you've got insurance demand, agricultural demand, climate change demand, and now defense demand rocketing ahead since Ukraine and the Middle East happened over the last 3 years. And indeed, you know, I got an OBE today from Prince William, which is one of the first in the space industry, to show that even royalty are catching up. And he actually, one of the first things he asked me was what I thought was going on in the space industry at the moment from the UK's
Okay,
standpoint.
Will, for our